Welcome to Money Masters. Today I am going to have a long conversation with Anand Shah, who is running the fastest growing among the largest domestic PMS in the country. And I have known him for a very long time, ever since he was a fund manager and a star fund manager and managing and progressing his career over the last 25, 30 years. But here I will have a conversation with him just for your benefit, to understand how his career has evolved, his learnings, and all the things that you can take away from this conversation as an investor. So welcome, Anand.
Thank you, Dhirendra, for having me here.
So now tell me, though we have been doing our anniversary issues and we have spoken to you on multiple occasions, BNP, Canara Robeco, and your previous stints at different places as you have evolved your career. How did the journey actually begin?
Yeah, it's a very interesting story, and I tell people that you can't really plan your career way ahead because it just happens to you, and it's so much so it happened to me also. So post my engineering, I worked for Kirloskar Oil Engines for a couple of years, and then wanted to pursue post graduation, and I chose MBA. And when I went to IIM Lucknow, I thought I'll do my major in sales
Which
and
year was it?
marketing. This was in year 1998.
98.
So I passed out my engineering in 96 and worked for 2 years. I was behind the machine, repairing it. It was good fun. A lot of learnings there, people skills learning as well, apart from the technical know-how. But when I pursued, I said I'll do my major in sales and marketing, and we'll see from where it goes. And it so happened that in the very first year, in the various accounting courses and all that, where I had no background, I excelled very well. I did very well naturally. But then there was courses on investments and research, which again I had a natural liking for. So then we did a major in marketing and decided to do the twin major of marketing and finance. And I think the game changer was my last semester, where we had a course of independent study where you actually don't have classes, you just do a thesis.
Okay.
And I picked up and the guide picked me up. My professor also picked me up, and I picked up a professor under whom we did an entire thesis on the investment strategies of Warren Buffett. So that's where I did a lot of research, and just that was the beginning. And it was very fascinating reading about that, very fascinating understanding that. And it was the beginning of the journey. I don't think since then it has...
That was just, germination of the whole idea that, okay, it is something worth, it's interesting. It is not a random thing. Okay. Yeah, because this would have been, 1998, which means
2000.
It is pre-internet.
Yes.
Pre-internet in
Just
IIM
before
Lucknow.
the .com crash.
Yeah. In these decades of, little over 2 years, 2 decades, how has your approach, what did you, how it all started? What was your initial belief system? What was your mental framework? When did you think you were able to articulate your, investing framework?
No, so it's more like a scientist. You started with a thesis. So luckily for me, I carried a certain thesis, which obviously was not enough, but it was a good starting point. And since then, over the last 25 years, I've been able to improve it, or rather add nuances to my investment philosophy, on investment processes. Through the last 25 years, been fortunate to work with many stalwarts of the industry through this last 25 years, have interacted and learned from others also. And that's how it's sort of a journey. I don't think I've reached a point where I'd said, look, I've achieved the final. I'm still learning, and we're still improving the same process and philosophy.
So, if you have to really articulate your initial thought, framework, imagine yourself in the first job and you are deciding in the morning that, okay, you have some extra money to invest in your fund.
Sure.
What was actually driving it?
So I think...
Do you had a checklist? Were you able to evolve one?
Yeah. So very early on, and this is something which has stayed with me for the last 25 years, it is companies that create wealth, not markets. And that's been sort of a driving force for me, that I've remained more bottom up.
Basic belief system.
Belief system of identifying businesses which can grow earnings at a superior rate and sustainable. I think the two operating words on earnings growth is superior and sustainable. These are the two requirements to start with, and then many other things to fall on. So that's where we started, or rather, the initial thesis which I did in IIM Lucknow. That's where I formulated this something called BMV framework, which is business management valuations. To achieve that superior and sustainable earnings growth rate, what does it take? So then you're saying first you identify strong businesses. Once you've identified strong business, then you go to management. If you don't have good enough business, then the management valuations will not help you. Once you have management also in place, so you have good business, able management, is when then you go to valuation saying, is it good enough?
Reasonably priced.
Reasonably priced. So I think that's how the framework got set. This was the starting point, and then you have added nuance.
This got established very early on.
Very early.
Okay. Tell me, your own personal investment decision, which would have contributed to, essential do's and don'ts for investments. Anything that you did personally, which?
No, I think I started off in the times of IT bubble. I started precisely in May 2000. It's when it was the beginning
height of Y2K boom.
And there was a lot of money being invested in IT stocks. And the first thing I did as a I would say, somebody who's the most junior, most in the team, I did a DCF on Infosys.
Okay.
And
he did a DCF.
So discounted cash flow model of an Infosys, and then when you do all the bullish projections.
Which was the job where you were?
So I started off with Kotak Asset Management.
So this is Kotak.
Kotak Asset Management. And that's where the most of the learning and grounding had happened. So we did the entire DCF, and you put all the projections into the place, but still you don't reach anywhere near the valuations at which the Infosys.
Optimistic projections will also translate into something where
which was much lower. But then obviously those were the times when IT companies would sort of acquire companies of their size at much lower price in India. And to that extent, the acquisition would also add value and so on and so forth. So I think those were the times, it always happens in all the bull markets that people are irrational.
Were you able to believe against that mania that existed, which we know by hindsight?
Yeah, and I had a benefit of not participating in it, so I was looking at it afresh. So you asked me that what, I think that has stayed with me.
Okay.
And my belief in DCF, and in today when my team comes up with stocks trading at 100 P, 80 P, I have no problems paying higher P multiple for a high growth companies. But the DCF has been a very good stress test.
Is it worthwhile or not?
Eventually you put all the bullish projections. At the end of the day,
it has to make money, or it has much.
Sales is vanity, profit is sanity, cash is reality. So I'm just saying, can you show me the most bullish projections of the cash flows over the next 20 years and bring it forward? And can you?
So with that in mind, you would have never participated in any of these new generation companies?
We keep on doing this stress test, and this helps me. And to that extent, this is really important that we sort of remain grounded, ask the right questions to ourselves, but also to the management. And you're right, if the DCF can't explain a particular company or a stock, it makes us think twice, thrice over.
You get cautious. So getting to investment philosophy, though we started our conversation about the roots of your investment philosophy. So, the core principles guide you besides this, rooted in DCF. Principles guide your investment decision across, PMS and AIF platform. This is it?
Yeah. So I think DCF.
Or is it more rigorous? It's more organized, or it's more documented?
So again, look, to get the DCF right, you need to get the business and the management right. So I think over years, we have further defined what stands for a good business. And very clearly, the first and foremost comes is the moat of the business. Every business that we invest in, needs to have a certain sustainable competitive advantage. I think this works beautifully, especially in tough times. Are you the last man standing? When the crisis, and invariably the crisis hit the economy and the markets, the businesses which moat would survive that and then again bounce back and actually are the beneficiary of consolidation in the industry, right? So I think the first question we ask is, does the business has moat a certain competitive advantage over its peers to survive and thrive in the good times? Second is growth, very, very important. I think it's much underappreciated, but I think the growth is the biggest driver of the wealth creation. So identifying sectors which will grow faster than GDP and then identifying the companies within those sectors.
This is the top-down.
No, again, this is all bottom-up, to be very honest. So a lot of work happens at the sector level also, whether it's per capita consumption, penetration.
Which is top-down in terms of identifying sectors which will do well. Then a company which looks like a standout.
Yeah, but it's both bottom-up, top-down.
It's a combination of both.
It's always a combination. So we are more bottom-up, but that doesn't mean we don't look at top-down.
Okay.
So identifying businesses which will grow faster than GDP and then identifying companies which will grow faster. So this is a parameter for the growth. And last, but again, something I picked up 10 years later is consolidation. I think the big driver of wealth creation has been a consolidating industry versus a
fragmented industry.
Right? So the industry which is consolidating trend tends to generate a lot more wealth. And if you have seen a destruction or a lack of a wealth creation, it's generally the industry where there has been a fragmentation.
Huge fragmentation.
Far and few in India, but nevertheless, those are the industries which you don't want to
get into.
So that's the B part. Then you come to management very clearly.
The guys who will execute better.
Competence and corporate governance. I think corporate governance, again, less appreciated in bull market, but it's again very important through the cycle.
But today, going by the regulatory framework that we have, the new companies law that we have, everything is legitimate and legal and everybody complies with it. So how do you differentiate? Everybody, if somebody does a reasonable thing, is a compliant business, how do you say that he's a good business? Because being good and being okay, how do you differentiate?
So there are two parts. One is a competence, which reflects in the numbers. It's a quantitative part of a evaluation of a management, be it sales growth, whether you're gaining market share, not gaining market share, reflects into the firm's ability to sell the goods.
So that's a
margins.
That's a moat, competitive advantage.
So again, the margins, which is your ability to produce stuff at cost. Do you have a margin superior to the industry, margin superior to the peers? I think a much lesser quantitative parameter which has been focused on is a return on equity, which has nothing to do with the executives but to do with the board. Whether these businesses that you are invested in have a ROE superior within the
framework.
Industry and all, because that's a reflection of how board has been thinking, right? And that's one of the very, very important
capital
aspect,
decision.
Capital allocation, very, very important aspect in the overall wealth creation journey. The corporate governance is, as you rightly said, the information today available is much more than what it was before. But how you treat your customers, how you treat your suppliers, how you treat your employees, these are all finer aspects. These are more qualitative
sustainability of the whole thing.
Sustainability of the whole thing, and how you have treated the minority shareholders in the past.
But somebody would not have got any opportunity to actually mistreat him.
Good for them.
No, like you will not be able to discover till he gets an opportunity to actually mistreat him or abuse him.
That's why I'm saying this is not the only aspect. That's what I'm repeating.
One of the aspects.
There are many multiple checks that we do before we arrive at that. And the benefit that we have at ICICI Prudential is that we have a very large research team and a lot of experience sitting there over the last 25 years. That we would invariably have a certain opinion or a view on various businesses from the fixed income side or from the alternate side and other places.
Bottom-up stock picking and top-down macroeconomic analysis. Which come first?
Yeah, as I said, bottom up will come first, and
Okay. So you'll spot a company and then you'll go about figuring out.
Exactly. On every company that we invest in would be stress tested for that
Okay.
top down. So as I said, whether the sector is worth investing in or not can be a macro call. That this is a sector which is fragmenting. This is a sector where the number of players entering are just too many. Case in point today, if you look at organized retailing, that there's a plethora of capital chasing that businesses. So you might want to stay away from that sector when actually it is where more players are entering that market. It will actually be painful before it will get better. Then you take that view. So top down is important. Once you identified the business, what a certain policy making in US, what a certain interest rates, what a crude oil will do to your company. So every company that we invest in will get then stress tested for the macro risks. And accordingly, either they will not be part of the portfolio, they'll be far lower in the weights if there are certain macroeconomic risks which are going to hit that company. Notwithstanding, it will be very strong, we'll have a strong moat, we'll have a able management, but you can always adjust the weightages all the way down to zero if the macroeconomic risk doesn't augur well for the business and you don't want to invest in at this point of time.
How do you manage this trade-off between valuation and growth?
To be very honest, there's no paradox. Look,
there's no paradox.
A value without growth will not work.
Okay.
And a growth without value. Let me explain. That if you have identified a growth stock, which means that it will grow earnings rapidly, but at the end of the day, you will have to buy it at a price where it makes sense.
Okay.
If you buy it at a astronomically high valuation, where the growth for next 10 years, 15 years is
inflated situation.
Yeah. So then you might make money in 20 years, but for next 10 years, it might be at the same place, which is not the luxury we have, right?
Similarly, you don't have that luxury. So
similarly, a value stock, again, without a growth, and that's been the classic example of last 20 years, if you see value for a very long time actually underperformed growth.
You are referring to deep value.
No, I'm referring to
relatively cheaper stock.
Cheaper stocks on price to book, on price to earnings. But the old economy, they didn't have earnings growth rate. Stocks didn't do well for a very long period of time. So, so for a value to perform also you need growth. And you've seen last 4 years have been great for the value stocks because you had a very broad-based earnings growth rate.
Okay, they also start growing, then only they perform. Okay.
Then only they will get, otherwise, almost for a decade before 2020, the value stocks perennially underperformed, and actually the expensive stocks did better than the cheaper stocks for a very long period of time.
You don't
so
find
we don't have a paradox. I will go one step ahead, and in our investment philosophy, we look at actually all the three. No wonder we are looking for growth. So that's
value,
but the growth should accompany with improving quality. I think even quality is not something which is optional. Every business that we own needs to have a certain return on equity and cash flows, which is a representative of quality. Today or tomorrow. It need not be today, but it invariably has to be there tomorrow. You can't buy a growth stock which will grow at 30% but will never generate cash flow. Will never have ROC. That will never create wealth. Because they'll keep on diluting.
So with a loss-making company, how do you actually, what are the hunches for its visibility?
No, so we have invested in loss-making business in the past. We invested, so in my career, I've invested in Bharti when it was not making money.
But initial years.
Look, at the end of the day, you had a very profitable circles where you're already making money and actually generating positive ROC, but you were expanding in newer circles. And because of which there was a loss. Similarly, in many businesses, that's where we call about unit economics. That if you have a unit economics in place, the loss is not an issue. And to that extent, you need to understand that what is the source of a loss. If the growth is a source of a loss, but otherwise the matured part of the business is generating cash flow, is generating return on equities, then it's not such a bad investment.
Not a bad deal.
So, per se, a loss-making business is a no-no, is not the. On the contrary, many cyclical businesses that we have invested in, the entry point would be when actually the entire sector is not
Cycle is
making
getting
money.
over. Acha, when not making money,
Will
at the
not
down,
be making
at the
That's
lowest
a good time
ebb.
to enter in many of those cyclical sectors.
And most individual investors try and pick the
Avoid that.
catch the high. Now I have one question I've been curious about asking you, because I have known you in the past only as a mutual fund manager, and now you are the biggest PMS manager, a PMS CIO, keeping an oversight on this large amount people are pouring. What is the key difference?
Let me put it this way: the mutual fund, you have retail investors, and AIF and PMS would have more HNI investors, and the assumption is that the risk appetite of those investors would be much higher than the retail investors, and that is the one reason why they will look forward to investing beyond mutual fund. They would have their own mutual fund investments, but to
This will be
have a
supplementary, and they are
supplementary investment.
they're willing to assume
post-mutual
greater
fund,
risk or
greater risk.
higher
So
return.
I think the starting point here is that the active risk, the ability of a fund manager to go away from the index and take a higher active risk, is something which is a flexibility that PMS in AIF offers, which is much more relative to the mutual fund. And that is the source of alpha also, right? At the end of the day, farther you go from the index, farther is the possibility of generating alpha. So that's the first step. On top of it, the longevity of the idea, again, and that's something which we continuously communicate to both advisors and the investors, that you have to come in for a long term. And to that extent, we are very focused on creating a portfolio or a construction of the portfolio which has a higher active risk, but also a portfolio of companies which will have a much longer journey of growth, will have much more longevity of that stock into the portfolio. So this is a prime difference.
This is a key difference.
But the way we see is the boutiqueness or the generation of the active risk comes from a portfolio construction, not stock picking. I think stock picking, we are very clear, be it mutual fund, be it PMS, AIF, we have a common research team, and the playground, the universe of the stocks which are approved are common to both of us.
This mutual fund and PMS, they are treated differently when it comes to taxes. You know, here mutual fund, I invest in a mutual fund, take my money out after 5 years, and then it will be treated as long-term capital gains, end of the story. In your case, every action that you do is subject to taxation.
Sure.
It's my demat account which you are, operating on. How much does it guide your investment decision making?
So again, as I said, longevity of idea is important, and to that extent, a lot of portfolio stays, or a lot of companies in the portfolio stays for a very long period of time.
Much lower turnover.
Much lower turnover than what mutual funds. But having said that, I think it's a safe assumption that this is a less tax efficient vehicle to invest into stock markets than the mutual fund. But at the same time, this is a vehicle where the active risk is higher. That is something which is available in this vehicle versus what's not the possibility in the mutual fund, where you're part of a many number of investors would have a different risk appetite. So that's the key difference here.
You would say that the liquidity and the concentration risk is more than compensated by the superior alpha and the scale and your strategy that you follow here.
More importantly, I think it's an option. So again, there's
investors
a lot
have
of
a choice.
For many years, we have been debating its PMS versus mutual fund. As ICICI Prudential Asset Management Company, we are going to our advisors, we are going to our distributors and to the investors and saying, look, it's not mutual fund versus PMS. It's mutual fund and PMS. They are different vehicles, and they serve a different needs of the investors. The investors who is happy with mutual fund, the mutual fund is sufficient for him or her, obviously this is a superior and more tax efficient vehicle than this. It's only when the investors' need is mutual fund plus, when they need a portfolio management services or alternate investment fund, which is in this case is AIF, that's when we are here to offer you. So we are a manufacturer. we are offering both the products. It's a need of the investor which will decide whether they'll use this vehicle or that vehicle.
In this part, my last question, that now SEBI has enabled that, a new strategy which can be pursued with 10 lakh rupees minimum for a mutual fund company. Do you think it will be a very credible competition to your PMS?
So again, we still, it's not out all the
but
all
the regulations,
details.
Regulatory framework is open.
We are studying it. To be very honest, our teams.
It will be designed as a mutual fund. That is the first thing.
Yeah. So that's actually an added advantage. To be very honest, that if it's designed as a mutual fund product, then it will be more tax efficient than this.
Yeah. No. So how are you looking at it? Will it be a very credible?
Indeed, it will be very, because that will increase the entire pie of the market. To be very honest, that's a product which will be then become much. Today, PMS is restrictive also, the minimum ticket size. So the number of investors which can participate
that will democratize those strategies.
This will democratize those strategies. It will expand the market in the first place.
But it will not be in your division of the AMC. It will be in the mutual fund division of the AMC, right?
For the asset management company,
it will be there. Yeah. Okay. No, so it will fall in your territory or it will fall in the other.
So as an asset management company, we will have to then devise the products in PMS AIF such that then we then cater to a next level of customers, because now you have an intermediate product
as well.
As an asset
so you look
company.
at it as a mutual fund, those strategies and PMS.
Yes.
Okay,
so today I have my investors in mutual fund which are graduating to PMS AIF after a while. Once they have that much minimum net worth, now we'll have an intermediate vehicle where they can graduate very earlier into a particular segment of the market, and then they'll graduate to more structured products.
Now I have a set of questions about your, fund management approaches and strategies. Please walk us through the investment approach and positioning of each PMS strategy that you manage. Say the contra.
So again, unlike so we have multiple fund managers, and we have created strategies which are uniquely managed and differently managed. So contra as a style, look, there are two sources of wealth creation. Price is equal to EPS into PE multiple. So change in price is a function of change in EPS and change in PE multiple. And why have one when you can have both? So contra style as a style pursues companies where typically you have
out of favor
to favor. So there is an acceleration of earnings growth rate, but that acceleration in earnings growth rate is not priced in. And
so
to that extent,
kind of situation will normally be.
Yes, and to that extent, you would actually get both EPS growth rate as well as a little bit of a re-rating. I think that's the simplest way of explaining what contra is. That to give an example, case in point is telecom, where there was significant competition. There were 6 players, 8 players per circle. Nobody was making money. And then when it turned, now the earnings growth rate is high, but at the same time, the valuations re-rating has also happened for the same earnings growth rate. Same applies to manufacturing and metals that we captured in the last 4 years, where they were in the pits in terms of profitability, price to book valuation.
Do you see such a thing happening in the banking sector?
I think banking is one of the large weightages for us. That's a very much a possibility for a select banks which will be able to maneuver through the challenges that exist in the market. PIPE is basically it's acronym for a private investment in a public equities, in the sense that you have an approach where you identify companies where the potential is very high, but you need time.
Okay.
And the liquidity might not be that great.
You are almost like incubating that investment as a private investor.
But they are all public listed companies at this point of time. That's where we look for such opportunities. So typically a small cap becoming a mid cap or a mid cap becoming a large cap is our target companies that we look for. Again, we identified 30, 35 odd companies where potentially they can become very large from where they are today. Or they're already large, but the valuations are low because the profitability is low. So in either case, we are looking at a far outsized rewards in each of these companies. All might not play out, but the few playing out is good enough. So that's a PIPE strategy.
Suggest me a PIPE situation 5 years ago?
So I think if you go back to 2020, 2021, we were just coming out of a very long bear market per se before that. The earnings was missing from almost global financial crisis, and maybe from 2011 onwards, your manufacturing activities and the capital goods supporting those manufacturing activity all were in the downturn for almost a decade. China had overcapacity of everything, from safety pins to boilers, from tires to tiles, whatever you want,
Chemicals,
they would
anything,
produce it and they will sell it to the world. And to that extent, manufacturing was suffering. Things, obviously, at some point of time, the industries which survived had a moat that they could survive that sort of a extreme pressure that existed from the Chinese exports. But I think since 2014, 15, on and on, we are hearing about Atmanirbhar, Make in India. There is a focus of protecting this manufacturing, whatever is left. At the same time, the costs in China are going up, the cost of people, the cost of pollution,
cost of energy.
So they are also looking for, because they are becoming prosperous. So few things coming together, and obviously COVID was another supply chain disturbance as another catalyst that we saw a revival in the profitability in manufacturing. So we had quite a few companies in our portfolio in 2021, 2022. Some of them are still there, some of them which have grown their profits manifold. They were net debt of 2,000 crores to their net cash of 1,000 crores, like that. So there are many chemical companies, metal companies which have.
How long it took from you? Because, in India we have been such a cynical, and understandably cynical for a reason, that the Make in India looks like a slogan till you actually see, and it takes time for it to get demonstrated in the marketplace or the economy, or that, okay, this is being said and it is happening. Because there is a lot of talk and very little happens sometimes, or that is how we have been used to. How long it took for you to become a believer from being a cynic, or were you not a cynic at all?
So again, look, there are two parts to it. One is the manufacturing which already existed since last 2
The revival of that.
The revival of that. That is what we have participated. The other one is the manufacturing which doesn't exist in this country and you want it to happen, for which
the greenfield projects,
and the new technologies, the semiconductors, the iPhone manufacturing and all that. So that's something which you can remain cynic. But manufacturing a steel, manufacturing aluminum, you being an auto ancillary, exporting
existing capacity coming on the forefront.
Cotton yarn, fabric. So those companies and those sectors have survived almost a decade of Chinese dominance in many of those areas, and individual companies in various sectors have survived. I think that was easier, and rightly so. That the times were changing. So it's been since 2000. So you had a change of regime in China. You had Xi Jinping taking over and saying quality of GDP versus quantity of GDP, pollution clamped down. So they started off with chemicals, then they moved to cement, then steel, then more recently on the coal-based power plant. So they have been also systematically reducing the carbon footprint as they become more prosperous. So I think it's been since 2016 that we are watching this space unraveling in different sectors,
in different dimensions,
but not impacting that widely because you're also reeling under the debt pressure because the companies had done significant capex run up to 2008 and all the way up to 2011. So a little bit of improvement in profitability in 2016, 17, 18 didn't move the needle. But it was happening since last 4-5 years.
Now tell me, what is this growth leaders, the strategy?
So as I said, we will have different styles which will suffice the need of different investors. So Contra is in that sense a little high risk or a high active risk strategy. Growth leaders will to that extent lesser of an active risk than Contra, but obviously much higher than a typical flexi cap mutual fund. So this is our flexi cap offering.
Growth leader is flexi cap offering.
Contra is flexi cap, value is also flexi cap, growth leader is also flexi cap, but they all three offer
different approach to this. What about ACE? What is this ACE?
So ACE is a growth strategy. That's our growth and quality. These are the two combinations where we are more relaxed about valuations. because we are pursuing our businesses which are more growth oriented, much higher moated businesses. And this is something which is again done wonderfully well over last 1.5 years.
What is it quantify?
It's very well known that quant is going to be the it's not going away. Quant is nothing but looking at markets dispassionately without an active
Without emotion.
framework, without emotions. You look at hard numbers and then you arrive at a portfolio of companies which you believe would do well. So we have invested a lot in our quant capabilities. We have
What are the kind of investments? In what capability?
In people.
Achha, in
so
people.
basically we have
So they are programmers?
so we have both somebody who is with the IT background, but somebody is market, because what we are actually doing is marrying quant as well as fundamentals.
No, sure. I'm just trying to decode
Yeah.
that what will a quant guy do in your AMC from 9 o'clock in the morning to 6 in the evening?
I think what a quant fund manager of ours is doing is receiving a lot of wisdom from the active fund managers. I think what we are actually doing is all the wisdom that we have, all the fund managers have gained over years. How do you quantify it? So if I'm saying BMV, superior and sustainable earnings growth, what are the source of those? So if I'm saying moat investing, and if I'm investing in only high moated businesses, what is a quantitative equivalent of moat, which is return on equity? So you will not have a very high ROE if you're not a highly moated business. If you're in a commodity business, the moment your ROE goes up, you'll have supply, which will kill the ROE. The only way to sustainably make high ROEs is you have a business which has huge entry barriers. While you're making high ROE, somebody is entering new cannot make decent money to challenge you. So what we are doing is we are quantifying many of these things.
So how do you approach risk management, especially in this volatile, overvalued market?
The risk management is a very integral part of the stock picking itself in the first place. So that's the first line of defense. The first line of defense is when we are identifying a business, the BMV framework, where we are first looking at business. Typically, that's the first filter, that if the business is, because what happens when you get a business right but a valuation wrong, it doesn't hurt you for long. It can hurt you for 6 months or 12 months. But when you actually get the business wrong, it can be really, really detrimental. The losses that come out of identifying a wrong business or a wrong management is much more and lasting than getting the valuation wrong. Now, I'm not saying that we can get the valuation wrong. We are focused on getting the valuation also right. But I'm saying the primary focus early on getting the business right is the first line of defense. The second line of defense is obviously we build a portfolio of companies. So even if a particular business which we thought was doing well and doesn't turn out to be that way, and we end up losing money on that, but the portfolio of companies make sure that we have a pleasant experience for our investors. That's the second line of defense. The third is risk management. I think as a fund house, we have again very, very experienced people who are doing independent risk review, both liquidity as well as concentration risk review of the portfolios, both on the mutual fund side and the PMS side. So I think if at all we are more risk conscious than we should be, when it comes to managing public money. I think ICICI Prudential is conscious of making sure that we do this money management business with the full responsibility.
How angry are your customers in the last 1.5 months?
No, that's why that's why it's very, very important that you set the expectations right. And in our presentations, the very first slide that we have is there are two constants in the market. One is wealth creation, and other is the uncertainty of that wealth creation.
All the time, yeah.
All the time. So last 25 years, we have seen corrections which are nothing. I mean, much more, which will tell you that the current correction is nothing compared to what has happened. In 2000, post-dot-com crash, you had a 40% plus correction. Post-Vajpayee lost election, you had a 30% odd
When we had a 12% correction in a day.
In a day.
So, you know.
And post-global financial crisis, we had a correction in excess of 60%. So my point being that having spent time in the market over the last 25 years, people have warmed up to saying, look, wealth creation is good. However, so I remember we used to go back in 2002, 2003, 2004, we used to explain why equity is a good asset class. We have crossed that hump. That's not the challenge today. We don't have to explain to
Even
people.
then you have your boss, I think, it was Mr. Sathe.
Yeah.
He hired you.
Yes.
So you were made to interface with customers even then.
No, so whenever we used to interact with distributors and because that was the time when the industry was very nascent. Equity as a cult didn't exist at that point of time. I would say even today, Indian households have much more gold and real estate than they have equities. So there's a long journey to go. But nevertheless, I think people have understood that equity as an asset class creates wealth over a long period of time. I think where people are upset, and you spoke about last 1.5 months, is we had a
new
long
investors
period.
always get upset, whenever they
we had a long, and unfortunately, we had a long period of markets when we didn't have steep corrections.
Yeah.
So almost post the Russia-Ukraine crisis, I think from June 22, we didn't have more than a 10%
I would call it,
correction.
early COVID days, that was one of the steeper corrections.
Yes. So I'm saying the corrections are normal in the markets, and actually they are healthier. To be very honest, we were also struggling with various pockets of the market were very expensive. And we're saying, look, I like the business, I like the management, I don't like the valuation at some point of time. There was a misallocation of capital. You had IPO markets which were unrealistic in terms of valuations that the various companies were asking for. All things will become normal. So to me, correction is part and parcel of the market. Uncertainty of wealth creation is given. The most
that is how it is going to be.
People want certainty of wealth creation in equity markets. That's a paradox. So you have a wealth creation, but you have uncertainty of the timing for sure.
You have been in the market for nearly 25 years now. 2022 now as an active investor. In these 25 years, what is your, what was your perception of risk in 2020? And, how it has evolved over these years?
No, invariably.
Has it radically changed over time?
No, I think we remain on guard. We remain cautious because bull markets are notorious. And it might be different all the time. I agree if you're saying that the regulations have improved, the disclosures are improved. I might agree with, but that doesn't take away from the fact that we'll have to be on the guard. You can still lose a lot of money because the cycles are there in the businesses. So the strength of the business, the moat of the business, and this all gets sort of compromised in the bull market, unfortunately, where people give less importance to the basic fundamentals. I think we are doubling down on that. Our discussions on moat of the business, longevity of the business, its ability to survive a downturn, and that's working very well for us, given that we have a small slowdown in the economy at this point of time, which is still nothing compared to what we have seen in the past, but nevertheless, there's some slowdown in the economy at this point.
How do you, leverage this ICICI Prudential AMC's research team to shape your investment ideas? How much of input comes from them, and how much of it is actually generated among the portfolio managers here?
You said about the risk management, and one of the elements of the risk management that we have put in place is what we call it a 6I principle. That every stock that comes and becomes a part of the portfolio, we have 3 people who would sort of have an opinion or a view, and actually a positive view before it becomes part of the portfolio. And one of those 3 people would be the research team. So I think we have a very strong, large research team, which is continuously evaluating 600 plus businesses. Be it quarterly research, be it meeting managements, meeting their competition, meeting a consultant in that industry, or meeting a supplier of that industry. So there's a 360-degree research going on, and this is a very fairly mix of experienced and new analysts that we have who are doing that job. Once they filter through a certain business which is good enough is when the fund managers myself and our fund managers gets into the act and saying which are the businesses within those 600 businesses where we have longevity of the idea. We have both delta EPS and delta PE opportunity in that. And that's how then the next level of BMV filter gets into the play.
How much time do you spend, mentoring all the analysts and the portfolio managers?
The key aspect, and I think a lot of hard work, but you need to give a direction. And I think everything that we spoke so far.
How do you drive these values in somebody's mind?
No, I think it's a continuous journey.
Okay.
Every stock that we discuss, we start with a BMV. Again and again, reminding that are we looking at the right things.
Okay.
And obviously our past experiences, both the pluses and the minuses. And many experiences that we share, it eventually helps. And to be very honest, the BMV is not permanent. At the end of the day, there is a colleague, there is a junior colleague who would come and say, look, we need to add this aspect to it. That is evaluated.
That
so it's a very changing view, and if needs to be incorporated, like the consolidation of industry versus fragmenting industry, and that became one of the very key element of the stock picking or identifying strong businesses was not there before it came into the existence after 2011 for me.
About the future outlook and the market opportunity that we see today, which sectors or themes do you believe are poised to benefit from, India's current economic life? In our conversation, you said that it is great to be living in India today as an investor, as a professional investor. So which sectors or themes do you believe, is going to be a very dramatic thing, is a once in a lifetime opportunity which you are facing or you are likely to witness?
So I think we participate in one such trend, which is when the Indian middle class embrace products. Look, at a different point of time, they embraced different products. They embraced FMCG way back in 90s, and since then the HULs and the Nestle.
You are from IIM Lucknow, and the case study being done is that 1 rupee sachets of the shampoos, which democratized shampoos in India.
Right.
But they are long gone.
Long gone. I'm just telling you the journey of wealth creation is generally following the Indian middle class. And that Indian middle class from FMCG moved to pharmaceuticals. And the entire domestic pharma industry didn't exist before 1996 at the scale at which it exists.
At the scale that we have now.
When he moved from, first he embraced scooters, then he moved to bikes. And that's where the Hero Honda came about, which is now Hero Motocorp. Then they embraced cars, and then Maruti Suzuki came into existence, and that's been the multi-bagger. The Indian middle class embraced private sector banking, and the rest is the history. So I think what my journey or my journey of investing has been is the journey of the Indian middle class, what it consumes. And to me, as the per capita income continues to move, my take is that the next round of consumption in the Indian middle class, upper middle class and rich would be more tending towards services. The product consumption typically sort of stagnates, and the next round of consumption happens in the services industry. So telecom is one case in point that we are embraced like never before. Today we spend 3 to 4 hours.
But that was basically not, that was a supply constraint. We didn't have one.
Yes.
When I started value research, it took me 8 years to wait for that landline to get that connection.
Correct.
So once we have that, then people, so it is not a matter of people embracing it.
Yeah.
We didn't have one.
No, but I'm just saying that amount of time we are today offering to our phone, which is anything between 2 to 4 hours of the day, that's unheard or unimaginable maybe 10, 12 years back. The amount of data we are consuming.
No longer it's a phone.
Yeah.
In fact, if I look at it, it's my calendar, it is my video, it is my communication, it is my messaging, it is my music store, or it's my iPod, or
and
everything.
It has implications on the consumption at the other. So if you're spending 2 to 3
I also
hours,
have the Amazon app.
That means that you have lesser time for something else. That's also an implication of
side effect of that.
We spoke about OTT and others, that the OTT was only possible with the advent of 4G data and all that. Otherwise, it was not possible.
It will not work.
And that has implications on the cable TV, right? So I'm saying that services, travel, airline, education, the amount of money the people will spend on the kids' education is ever increasing. It's again not new. I'm just saying that the larger
broad trends will get
diagnostics, hospital, even the insurance products. These are again financial services which will, my take is, will have a much longer journey for growth versus many other product companies. So very clearly, if you see the growth rates in the so-called FMCG, which is supposed to be fast moving, is the least compared to many other consumer services. So that's one. The second one is, I think, manufacturing. I can't take that away because if you have to make this large population an asset, you need to create jobs for this. And I think there has been relentless efforts in making India manufacturing. I would not use word hub. Hub is just too big, but a center for part of a need of the domestic consumption, but also some bit of a export demand if we can cater to, because we have all the elements here.
All the variables in place.
All the variables in place. And to that extent, we can have select opportunities in manufacturing which can do extremely well. Banking financial services itself is a sector where we again believe.
These are broad themes, so something like energy transition. So as you said, that the Indian consumption story or the Indian middle class or, the digitization, that has a big implication, the way we are, the way the your vegetable vendor is actually taking a payment and that to 15 rupees and it's happening effectively. Or the infrastructure growth. How do you incorporate all these in your funds, in your various strategies?
So again, as I said, these are all macro inputs which you are talking about, and unfortunately, that's not enough. At the end of the day, to identify businesses, they will benefit from, but all will not benefit from that. So what you're saying is happening for last 20 years. It's not that every company in the banking has created wealth, not every company in FMCG has created wealth. So these are all good macro inputs, and they're needed. In a way, it's a beta, right? It's a growth in the economy is the foundation on which will create alpha.
Whole of the market is beta. So
the whole of the market is beta. So a good beta is never bad. Then to generate alpha, that's where the stock picking comes into play. Which company is able to make the most of the beta that this country is offering?
Which is the momentum that we have. What's your view on this large cap versus mid cap versus small cap valuation?
So very clearly, the entire market for long has been divided between the so-called growth stocks and the value stocks. And as we see in large cap, there is very clearly a segment of the market which is very expensive and the segment of the market which is reasonably priced. Similarly, it applies to mid caps and small caps. So again, we are approaching the small cap and mid cap very similarly the way we approach large cap, which is going more bottom up. No doubt, the risks are high when you get a small cap and a mid cap wrong. If there is a stock where the business is on a downturn or a management is not favorable or the valuations are too high, the exit costs are much higher than what it would be in the case of large cap. So risk always, we knew the risk and reward are always higher in mid and small cap. The due diligence required so much so is much more than in mid cap and small cap at this point of time, as much it is in large cap.
You were talking about all the methodology, about the quality and not getting wrong with the business, maybe getting wrong with the valuation, and that is when you can actually save the skin. Or given your framework, in the small and mid cap, what percentage of your recommendation or components of your portfolio has been very embarrassing?
Actually, we've been very conscious. Again, as I said, we have this 6I principle. Every stock that we invest in, we typically have at least 3 people having an oversight on that company. It's not saying that our stocks and our portfolio is not corrected, but I think the business fundamentals, the quarter after quarter that results come through, the profit numbers, the cash flow generation.
Completely shady companies have not been able to creep into your portfolio.
Luckily not.
Okay. Now I'm done with the interview. Now I have some personal questions. And they're very interesting and I'm very curious to know about it. What has been the most challenging period of your career and how did you navigate it?
I would not use the word challenging. I think we've been very focused on identifying sustainable businesses. But I think one of the periods when we had a performance pressure because we had overweight positions in telecom.
Okay.
And with the advent of Jio, the prices just collapsed in that sector. At the same time, the costs went up. And the rest is the history, how detrimental that's been the combination where the prices drop and the cost goes up. But I think we were very clear it's a B2C business. It will not be easy to crack a B2C business for new entrant. We've been sort of proven wrong there. Somebody with a strong balance sheet and a strong pricing has been able to gain market share at the cost of incumbent. So it was not that much of a high moated business as we thought it was.
As you thought it will be. Yeah. How do you handle pressure of managing large sum of money with varying investor expectation? You will have all these affluent people, but you will have people who are investing 50 lakh, and there are people who are investing 50 crore, and there are people who will be investing 500 crore in your fund, and managing their expectations. How tough it gets often.
So again, I'm saying we are manufacturing a particular product, and we have this conversation right on that, look, this is the product which we are offering. It is for the investor to choose or not choose that product. And as I said, we've been sort of creating few different products. We discuss about various products. One might not suit an ex-investor, might suit the other ex-investor. But at the end of the day, we stay true to our communication, our product.
You have set out to deliver this, and that is what it is.
That is what we do. Principles are very clear at the start. The communication is very clear. And that is something which we live by, then it's easier to
grapple with that. Okay. Now I have this question for which you have already answered, but for the sake of brevity and summarizing it, my last question: what investment principles do you believe are timeless, regardless of market changes? Though you have answered it, but just for the sake of summarizing it.
I think first and foremost, at a very broader level, we'll have to embrace uncertainty. If you're saying that I know everything and I'll get it right all the time, is the first roadblock to being successful in the stock market.
Fallacy.
So I think while you can identify good business, strong moated businesses at a reasonable valuation, that doesn't stop from that stock to fall. So I think to embrace uncertainty and to embrace that I have no idea how the stock will behave, I think that's the first step of being successful in investing. Subsequent to then obviously, companies create wealth, not market. So I think focusing more on individual companies' strengths to survive, because downturns will always be there. To say that there will be no downturn, and if you invest in a company, that will be very, very dangerous. I think at the time of investing, you need to be mentally prepared. There will be tough times, and whether my company which I'm investing in
will survive
that downturn.
So thank you very much, Anand, for being here.
My pleasure.
Sharing your insights with such generosity. Thank you.
Thank you.